All right, let's go ahead and start going through this. You want to submit this to ELMS after you verify you have the right answer, but before you leave class today. So, if I get everybody's attention, start out with the CFI. So for the CFI, you'll see that AbbVie had 3 years where they had negative goodwill and 2 years where they had positive goodwill. So let's start out with the changes we have to make on the negative goodwill. So for 2013, it was negative 286. So you could have just zeroed it out. Keep it simple. Come down here, the other adjustments to equity, subtracted 286, and verify that these two CFIs are now back in balance. For 2014, it was 792. Again, you could zero out the 792, come in here, subtract 792, and make sure you're in balance. And then finally, for year 2017, zero out the 969, subtract the 969, and again, make sure that they stay in balance. Okay, so here's the deal, and I'm trying to keep it a little bit more simple than what we talked about during Monday's class. And the idea is that basically this, that once a company disposes of an asset, by definition it becomes one-time, non-recurring, and therefore non-operating. Okay, because the whole point of operating cash flows is they're recurring. And if I sold something, it's going to be a one-time sale, and I'm not going to see it again. So that's actually why it can't really be part of free cash flow. So in terms of do they get cash from the disposal of assets, the accountants would have handled that, and they would have put that in the cash balance in the balance sheet. So it's not like we ignored the cash. And in an ideal world, we could have handled the disposal, but in an ideal world, we would have put the disposal here into the non-operating section. So for simplicity, it won't change what your free cash flows are, and it won't change your analytics that you're going to do once you take out the disposal. All right, because what you would have done is basically you've done these 2 years for free cash flow, because once you sell the assets, they're no longer part of free cash flow. You would have done these 2 years because when you buy something, you're buying it with the intention of using it to sell more products, and it's recurring, so therefore it is part of your free cash flow. And then you would have gone back here. All right, since we've zeroed it out, you can pretty much, now that you've zeroed it out, just use this for your analytics. And that's what you would talk about in your CFI. All right, the fact that we didn't account for it here doesn't really matter because it won't affect the free cash flow and it won't affect the distribution of cash here. Now, the reason why we're changing this account, other adjustments to equity, because I had this question in an earlier class, is you can kind of think of this as the plug to the CFI. So, for example, if you do a balance sheet, retained earnings is a plug, all right, because shareholders get whatever's left after everybody else has been paid. Well, the same idea here on the CFI, that other adjustment to equity is the equity adjustment that would have to be made to get the balance sheet to balance. All right. Now, typically, we're trying to track the adjustments based on what's actually happened in the balance sheet. But what I'm telling you is that if we had to make a further adjustment for the disposal, we're going to make it to something that actually won't change the cash flow, the other adjustments to equity, and won't affect our free cash flow, which is what we cared about for the analytics. So trying to do a more complicated process, I've just decided is really unnecessary for what we need to accomplish, and I'm just trying to keep it a little bit more simple for you. So these are the adjustments that we needed to make. Questions about the adjustments? Because again, you're probably like, this seems simple, and I'll say, good. Like, this shouldn't be that complicated, the adjustments we're making here. Questions about these adjustments? Because what's important is you have to do this one more time for your group project company. Okay? So if your group project company, like AbbVie, has negative goodwill, then you have to make that adjustment there as well. Okay? Same as we just did here. Okay? And ideally, what I'd like you to do is tell me that you did it. So put a little asterisk under your CFI, and in your PowerPoint and your paper say made adjustments or something like that, so we know that you made the adjustments. All right, but nonetheless, this is the adjustment you need to make. And if you were actually analyzing the CFI once you did the adjustments, you'll notice that these 2 years, AbbVie spent a ton of money on acquisitions because they added, you can see the number there, close to $37 billion of goodwill in those 2 years. So what I would also say is that's prime for a question that I would be asking you as part of your group project team, right? Because basically I'm going to be like, all right, who'd they buy? This is not an insignificant acquisition that AbbVie did, right? So you need to know that question. By the way, the answer to that question, if you actually go to AbbVie, I don't know if anybody's actually using this feature of DES, but in DES, company description, if you click on more, would you like to know more, then Bloomberg does a good job of kind of summarizing the things that are going on for a company. And one of the things they're talking about here is who they bought. So specifically, in 2015, they spent $21 billion for a company called Pharmacyclics, if I can pronounce that right, that makes Imbruvica. And in 2016, they bought for $6 billion a company called Stemcentrx, which makes Rova-T and something else, right? And that is going to be important to the AbbVie valuation and as is for 2 reasons. Number one, it's going to be important because that explains the acquisitions of the goodwill if you're talking about their CFI, right? And number two, if you go to EEO, right, some industries, pharma is one of them, have a third tab on EEO, which is metrics for the industry. If you click on the pharmaceutical tab, this is a forecast of AbbVie by drug. So these are all their forecasts for each one of their drugs, including ones in development, right? And so if I'm trying to understand AbbVie and think about the EIC assignment that you have on AbbVie for Monday as a proxy for your group company, then what you need to do is you should say, okay, Humira, which by the way went off patent in 2016, which you would have read about in AbbVie, is a $20 billion drug per year. That's about 2/3 of AbbVie's total revenue. All right, so they're kind of like a one drug company. So ever since they've been split off from Abbott Labs back in like 2012, 2013. So that's what created AbbVie. This was their core drug. And they were a relatively predictable business because they're pretty much a Humira business. And Humira was under patent and stayed pretty stable. Well, what's about to change with AbbVie is, number one, now that it's off patent, the analysts haven't forecasted a drop, but sales are likely to drop of Humira over time. And number two, it's going to be replaced by some product launches. What are some of the product launches? Well, there's a drug called Rova-T, which is launching this year and eventually is $500 million. There's a drug called Elagolix, which is launching this year and is going to be $1 billion drug in a few years. And there's a drug called, I can't even pronounce these names, Upadacitinib, that thing, the U drug, which again, potentially forecasting $1 billion drug in 3 years. Those 3 drugs came from those 2 acquisitions. Okay, so the thing about AbbVie is they've been spending a lot of money in R&D, and they bought 2 companies to basically replace Humira, which was going off patent. And as you understand the as-is valuation, and as you talk about the EIC, this is critical to understanding AbbVie, the company. And so when I'm going to be judging you on your group project, is this is the type of stuff I expect you to understand for the companies that you're evaluating. And here's why. When you did your as-is, number one, they talked about the tax rate of being 9% going to 13 over time. All right, so I use 13 to be more conservative, but that's the advantages of setting up tax havens in Ireland, okay, even with the low U.S. income tax rate. Number two, their margins, EBITDA margins, based on this trading multiple of EV to sales and EV to EBIT margin of 47%, which suggests an EBITDA margin of almost 53%. If you look at AbbVie, whose historical EBITDA margins are in the 30s, and even in the next 2 years are in the 40s, to go to 52.7, to be honest with you, looks crazy. Like on the surface, you look at this number, you're like, there's a mistake here. It can't possibly be this high. Until you dig in and you see that AbbVie has $3 billion blockbusters that are under patent protection that are just being launched in the next couple of years that are going to have like a 90% gross margin. And that is actually going to give them a big bump up in their margin. So what's behind this as-is valuation is an assumption that, number one, Humira, which is off patent, doesn't crumble. And number two, that these drugs that they bought and are launching are going to become billion-dollar platforms. And by the way, that number is probability risk adjusted. So what the analysts will say is, hey, this drug hasn't launched yet, so what I'm going to do is I'm going to make a probability of like 80%, and I'll take my actual forecast times 80%, and that's the number. So the numbers could actually be bigger. But the point I wanted to make is that what explains the increase in EBITDA margin is the fact that they have multiple drugs in their portfolio that are launching under patent protection, which is the most profitable time for a pharma. So that's what makes AbbVie interesting. And number two, it makes AbbVie more profitable to justify our as-is valuation. Now, continuing back to your valuation file, basically solving for G, you should have gotten a G somewhere around 3.5%. Okay, so given a G of around 3.5%, what you then would have found is they actually need growth rates close to 7.5% in those out years, which again, if you think about what we know, companies regress towards the mean, and they're a mature company. So this on its surface would look difficult for us to believe, except we just did our homework, and the reason why they're growing is because if Humira stays stable, and even though they lost patent protection, and they add these new blockbusters, well, they are going to go into growth mode, and it's growth at high profit, and that's what explains their stock price today. Okay, so that's what we're putting together when we do our as-is valuation. Now note, you may disagree with this. Okay, you may disagree that a drug off patent doesn't lose a lot of sales, and that Humira is not going to stay a $20 billion franchise for long, and it could see competition and a decline faster. That is what you'd put into your bear. That's what you would put into your target. Okay, but what we know is that at today's valuation of AbbVie, the analysts are being more bullish, where they're basically saying Humira stays the same even off patent, and the new drugs are successful, and that everything works out well. So to some degree, as I think about AbbVie, their stock price probably has a lot more downside risk than upside risk, because if you think about it, they're trading today with upside. Right? There's not a lot of negative things that are happening to this company based on what we just did in the as-is valuation, which is why we do the as-is. And as I said, we don't have to agree with this because you're going to put your opinion into those other three files. Okay? But using the academic formulas, you're going to come close to the data that I just said, and you're going to get some data that looks out of sort. But by doing the EIC, you quickly realize it's not out of sort because it is somewhat reasonable given the change in the business that we just talked about. So that's what's important, and I'll just pause here and say questions about any of this. And oh, by the way, to complete an as-is, you should have also put the multiples in on that tab, because otherwise you have an incomplete file.
Any multiples?
Well, however many you have, you need something in there.
Cool.
I'll talk about why I put those in there in a second, but anyways, other questions? Yes. Yes.
We need multiples for the previous as-is order too.
Every as-is should have the multiples, because that's part of our process. The one that matters is your group project. For this assignment or previous? No, we're not the previous. For this one, make sure you put it up. Yes. Hold on, one at a time, please. Yes. All right, so let's talk about multiples here for a second. So, homework 10. So if you got to this point, you've completed extra credit, 3, you can upload the file. Okay? If not, please get to this point soon and upload it before you leave today. Get your 2 points. You just need the Excel file. There's no write-ups. Now, coming up on Monday is homework 10. Due Monday, 10 a.m. for all sections. That's an EIC. As part of the EIC, you're going to have to turn in 2 screenshots, as well as a write-up. Screenshot number 1 and 2 are at the RV screen. Screenshot number 1 is the beta. So if you go to RV, Markets, Beta, to talk about the economic sensitivity, we need the industry beta, industry raw beta, and the company's raw beta. It's right here. That's your screenshot. All right. Now, let me address the question that was actually asked a minute ago. And she said, do I need to have as many companies as I do on this list, or is 6 good enough? And so here's the point. Think about it this way. What we're trying to do is get a representative industry beta. We get the company beta, but I need a representative industry beta. So the question is, if you go to Bloomberg default, they gave you just AbbVie's North American peers, basically U.S. big pharma, which there's only 5 of them. And so the real question is, do you think that this is representative? AbbVie gets half its sales outside the U.S. They're a global pharma, and the global pharma business that they're in, is this representative of the industry? So that if I use that line, I say, pharma has this beta. And I would say, no. So therefore, what you have to do, and then, like I said, forget the check the box mentality and just put your thinking caps on. What I'm saying is, I need something that is representative. So I'll give you 2 ways you could have addressed this. Number 1, what I did is I said, okay, Bloomberg also has a global large pharma peer list, and this list, which is more longer and has the same peers on it, I think this is actually more representative of the global beta. Notice, by the way, this is 107, and the U.S. peers are 104. So it's not dramatically different, right? But if it were, then that would scare me to say I need something that is representative. Question?
How can you compare them if they're regressing against different indices? Like, you can't compare, when you go to the global one, the other indices could be far more like volatile.
Yes. So the short answer is,
if this company in this index is stable, but the index is not, then they have a high beta, but it's not representative of the company.
Great. If this were an MBA class, which it's not, what I would have had you do early in the semester is you would have taken the beta against something like the Morgan Stanley Global Index. And so rather than using just a beta against a country index, which could be small, and as you said, over-representative, what we would have done is we would have created custom betas against like a global index, right? But for simplicity, I've made some choices throughout the semester to make this manageable in an undergraduate section. So I'm just saying, on the point you made, that's actually an excellent point, and it really shows a deeper understanding. So I'm glad you actually recognize that as a challenge. And that's actually how we should address it. And by the way, if you'd like to address that in your project, I'm not going to limit you to making better choices. But at a minimum choice, we need a more representative list, which leads to screenshot number 2. Yes?
For the screenshot, our item is just like the first 8, or do you want us to expand?
Well, I want to have the companies, and my Bloomberg screen, I got rid of in the settings the top of your screen, which just takes up a lot of real estate and is not helpful. So, but what's important is if you have the number of companies on this list to get this market cap weighted average. All right, so what I'm less worried about is seeing every name on this list than getting this top row. And I just want to have enough data points that that's a representative list. Same thing. When you do the second screenshot, you go to custom, and you're going to do operating ROIC. against WAC, as opposed to Bloomberg ROIC as of the latest year. So what we're comparing for industry attractiveness is 21.2% against 10%. What we're comparing for competitive advantage is 32% against 11%. It is clear that AbbVie has competitive advantage. And that is something you should be discussing in your EIC write-up. The reasons they have competitive advantage are what we just talked about, because they have one of the best-selling drugs in the world, $20 billion a year of Humira, and they have several new drugs that are going to be blockbusters that were through the acquisitions they just made, which are also about to hit the market at very high margins and good growth rates that are going to add to Humira. That's why AbbVie has competitive advantage going forward, right? So I'm just telling you, these are the two screenshots you need. So back to representative. If you didn't use this list, you could have gone down to GICS. And if I did GICS, I could have done the global GICS list, which looks very similar to the Bloomberg global list. But the point is, if I did operating ROIC here, the GICS list, same thing, slightly different numbers, but nonetheless, it shows me the representative industry. Because that's the whole point. I want something that's representative of an industry average. And having a narrow list of competitors, unless you're FedEx and UPS, probably doesn't make sense. You know, I could see if you did FedEx and UPS or Home Depot and Lowe's that you probably have a narrow industry because there's just not that many companies. But pharma is a different animal. There's a lot of global pharmas. And I think AbbVie, to really understand how they're performing, we need to include them in that list. Okay? Questions about any of this? Hopefully this makes sense. Yes, sir.
What is ROIC-Y?
Is this what?
What is ROIC-Y?
Based on the latest year. Now, the reason I used year, so it's another good point you're bringing up, as opposed to latest filing on this screen, is right now it's late April. And some companies are now reporting their first quarter earnings, but others have not. If we use ROIC of latest filing, what will happen is some companies' ROIC in this list will include first quarter 2018, and some companies won't because they have 90 days to report, and we're still at the beginning of the quarter. So the danger for that is you're just having a little bit of an apples and a pear comparison because you basically have some 2018 data and some 2017 data mixed together. Now, if this were June, early June, and almost all these companies reported, latest filing would make sense. So I chose latest year just because I'd rather keep it constant for December 2017. That's actually why I did it. So good point to bring up the subtle choice that I made. But the real point is you're not going to use this number. You're going to use this number. All right? Now, the only reason you would use this number is if your company were Shire, which was in the news yesterday, because Shire, what happened to Shire? By the way, if this were the class and pharma was our industry, regardless of your company, I would expect you to know what happened to Shire. Yes. Who?
They're selling to Japan.
Takeda, yeah, is buying them. And I'm just saying, when you have a $100 billion acquisition, then it's something that's news in the industry that you're looking at. Okay? So, long story short, Shire, they made an announcement to potentially merge with them yesterday. But the point is, if I were doing Shire and I don't have a data point, I could default to the Bloomberg ROIC, so I at least have something. Again, operating ROIC is preferred, but if I don't have one, I need something. I could use the Bloomberg ROIC. So regardless, you're not doing this for this assignment, but that's actually why I left it in there. Okay? Again, great questions. Other questions? Because this is our last lecture before your group projects. So this also spills over into some things that you should be doing in your group projects.
Is this a video right now?
This is being recorded right now, so it will be posted in just a minute.
Okay.
Yes.
How did you get your ROIC the latest year?
When you basically choose, so I'll add a column here. When you type in ROIC, any Bloomberg field, will ask you what period you want to use. You don't need that column to do the assignment. I was just putting in there to illustrate the difference between what we started with and what we're now using. All right. So, just to be clear, for Monday, 10 a.m., turn in homework 10, which is an EIC, which requires these 2 screenshots and a write-up. By the way, for those of you working on your group project, those are the same 2 screenshots you need for the EIC section of your group project. The other thing I want to mention about the EIC section is the 5 forces. You have to do a 5 forces for today and 5 years from now. Now, here's the thing. Many of you look at this, in my opinion, as a check-the-box activity. Okay? You're just going to put a nice table and you're going to put in some random words. Right? What matters more, I'm not saying you don't have to check that box, but what matters more is what I started with, which is, hey, this is an attractive industry, and if I think about competitive advantage, they have competitive advantage because of Humira, and they have competitive advantage because they have some new drugs that are coming through acquisition that are about to launch on patent. And that's their competitive advantage. That's why they have a more attractive ROIC. As a matter of fact, they are sort of contrary to what we would expect with their competitive advantage, where their operating spread is going to increase over the next 5 years, which is something we normally wouldn't expect, and that is going to help them. So I would say that they're actually in a reasonably good environment that is actually, they're doing even better than that environment, and this informs why I say what I say when I do the EIC. So again, the point to all of this, as we move towards the end of the semester, is it's not just that I want you to do the numbers, but I want you to kind of tell me the story of the numbers. Like, what's behind this? What's happening? A, it will make our final presentations more interesting and valuable. And B, that's where you really get the learning. Like, the questions that were just asked are really good questions because now it's showing more insight, and that's the point. At this point, you guys should be sharing me some of the insights that you're getting about the companies that you've spent some time with. And that, in addition to the math, is very powerful. And it's a great skill, by the way, to have it once you get your jobs. Okay? So, final questions about any of this? Because we got one last important thing to do relative to final presentations. Okay, so for final presentations, I want to talk about we have 7 teams, and next week we're not going to have any lectures, and I made the unilateral decision to eliminate group project 3. There's actually 5 points, went back and checked on the syllabus, and your presentation paper is now 25 points rather than 20 points. Okay, so I moved the 5 points and I killed the project. So next week, after you turn in homework 10, you pretty much have the whole week to just work on your group project. Strong recommendation. Get the data at the same time. I told you you can do a date as of, but don't get the data on EIC on Wednesday and multiples on Friday. Here's why. Whatever company we analyzed last week, and I've completely forgotten it, whose share price went down by $8 over a couple day period of time, like if that happened to your company and your stock price went down dramatically because they reported earnings and they were bad or missed expectations, then you're going to have multiples that don't sync up with your valuation. And that's going to cause challenges for your group. So get all of your data at the same time next week. And I strongly recommend not waiting till Sunday, because if it's Sunday, right before the presentation's due, you might not be able to get in this lab, and worse, if there's a problem, you won't have time to fix it. So since you have time in class next week, I'd recommend Wednesday, Thursday, or Friday having your team get together, grab the data. At that point in time, do it as of that day. Yes?
I know it's like earnings season right now, but suppose we present on a Wednesday and report earnings on Tuesday. Are we expected to talk in depth about earnings?
I wouldn't say in depth. Like, your valuation analysis will be based on what you pulled. However, you should still understand what the earnings do if it changes anything and make a reference to that. You should be aware of other data that happens. Okay? Go ahead.
So we can have for our data for our model, we can have a free earnings data.
Your data will be as of May 2nd or whatever date it is. So say that very clearly in your PowerPoint, in your paper, data as of whatever day.
Okay.
But what I'm saying is, for all your data, get it on the same day. All right. Last but not least, and then we're going to pick team order. I'm very, very specific about this. For most of the semester, I don't really care if you're here. You're adults, you can figure out whether you want to be here. And while you're here, I notice some of you don't always pay attention. And again, you're adults. You don't have to listen to anything I say. It's up to you. But for these two classes, when we're making presentations, the rules are different. Okay? And these are my rules, and I'm going to be a prick about it. So, number one, it's not about me. It's about you. So the people that are going to be presenting are going to be nervous. All right? And it's a big 25% of their semester grade. And so we want to give them, A, an environment to be successful, and B, we want to show them respect for the work that they have done. So what does that mean for you? It means, number one, that when you're here both days, you will listen, you will close the computers, you will silence your phones, you will not clack on your keyboard. If I hear any typing on keyboard or looking at any phone, I will ask you to leave. And you will lose 5% of your semester grade, or if you're presenting, you'll lose 25% of your semester grade, and I'll give you no credit for your team's presentation. That's a hard rule. Don't violate it. Last year, 2 students tested me, and I threw them out. And then they said, oh, we didn't think you were serious. So this is on YouTube, just so you understand how serious I am. You will respect the people in this room, and if you're not capable of doing it, don't bother to show up. All right, because I will be very difficult on you for that. It's just courtesy to people. Second comment is, I don't care, and I hope it's warm. I don't care how you're dressed today, but you will not wear flip-flops. You will not wear sweatpants. You will not wear shorts on either day, whether you're presenting or not. So you, I would send home immediately. I wouldn't let you in the room. And again, you would lose credit for your semester grade. He's wearing sweats. Right? So at a minimum, jeans. I don't expect you to be in a coat and tie. I don't expect you to be in a suit or very fancy outfit. But I do expect minimum business casual. So no sandals, no flip-flops. Tennis shoes are fine. Not ripped complete jeans are fine. He's okay. He would be okay. All right. She would be okay. All right. But the point is, just come. He's in a coat and tie. It's probably an interview. You don't have to be that greatly dressed. If you want to be, that's fine. I'm not requiring it, but minimum dress code. Business casual. Both days, whether you're presenting or not. Yes?
You already answered if you're presenting.
If you're presenting, are you still business casual? Or
You're welcome to present business casual. Other than business casual, I'm going to judge you what you say, not on how you look. But what I'm saying is, out of respect to the people in the room, I don't want you to come disheveled and uncaring. And you're going to pay attention to them and show them respect because they put a lot of time and effort. As I said, they're nervous, and we don't want to add any more distractions, and for your own benefit, to what you do. So we're going to come, we're going to pay attention. And you had to be here both days. Attendance is actually going to be taken both days. So please come prepared to present, even if you're not the presenters. So final thing, for presentations. Does anybody have any university-approved reasons to not be here on one of those 2 days, which would cause your team to have to present on the other days? Okay, great. So let's select the order. We have 7 teams. We have 2 days. 4 teams will present on Monday. 2 teams will present on Wednesday. 3 teams on Wednesday. So let's talk about Wednesday. So basically, I'll put it here. Now, because Monday is, in my opinion, a slight disadvantage, I will take any volunteers for Monday.
You didn't add benefit?
Yeah.
I will grade you equally. I wouldn't call it harshly, but I'll grade you equally harshly on both days.
Just so there's no incentive. No volunteers.
I'm going to start writing names here, but in case anybody really wants to. Yes? So you guys are Monday? Which team again? Monster? Monster? Oh, the beverage company. Sorry, I forgot who your companies are. I was like, Monster? Okay. All right, any other? Got to remember all the company names here. Thank you. All right, so 301, we have Monster. Who else? All right, so since we have Monster, then Dr. Pepper Snapple is probably good to go along with Monster, which also means that on Monday it would probably be good to have Coke and Pepsi
No.
on Monday as well.
We should choose Wednesday. We have the first pick.
No.
We're no longer in a democracy. The time for choice was given.
We have the first pick, so we should go Wednesday.
Coke and Pepsi, because again, part of this as well is getting a chance to hear more about peers. So I think we'll learn something by having them together.
For Wednesday.
Yeah, can we do like Coke and Pepsi on Wednesday?
Well, here's the thing: Pepsi, if we run out of time, goes to Wednesday because they're the last to present.
Run out of time, people.
Yeah.
But we have to finish by Wednesday. So then we'll have the beer companies. We'll have Molson, ABI, and National Beverage on Wednesday. All right, last but not least, Molson, ABI, National Beverage. All right, hold on, let me just save this.
You don't have our group on there.
Who are you guys?
Biz?
Is that National Beverage?
Oh yeah, it's national beverage.
Oh, never mind.
Okay.
We haven't
I
started.
can add you again.
We clearly haven't started yet, as you can see.
Okay. All right, so I'm going to save this, and